Oh, how's it going, friends and family? My name is Amos, and welcome to episode 3 in Dividend Compounders with Cheese. In this video, I guess it'll be 3 parts. In part 1, we'll quickly go over how the portfolio is doing, and then right after that, we'll be talking about what I would personally do if I came across a large sum of money, such as winning the lottery. And then in the third part, I'll talk about why I make videos about high-income ETFs, knowing full well that I'm a young guy, and it doesn't really make sense for my age bracket. So if that sounds good with you, let's go ahead and get into it. If you can't tell, dude, I'm so exhausted. My little baby, she's about to turn 5 months old here in a couple weeks, but she's going through her sleep regressions, meaning she wakes up all throughout the night. And then just the other day, I took her to get her 4-month-old vaccine shots, and it's just been messing her up. High fever and everything else. So, yeah, no sleep for anyone in this household. So it's been rough, but I know I'll get through it. Right? So starting out with part 1, how's the portfolio doing so far? In almost 3 years, the total return is about 88.7%. And we have just shy $38,000 of cash invested into equities. And for full transparency, there is cash on the sidelines that I'm using strategically to dollar cost average. The dividend yield is 2.2%. And if we were to do a comparison year to date to the NASDAQ 100, let's see how the portfolio is doing. It's 9% year to date, whereas the NASDAQ 100 is negative 1.6%. And if we do it again with the S&P 500, that's otherwise referred to as the market, the standard that everyone is trying to beat. Because historically, the CAGR for the S&P 500 it hovers between 10 to about 12%. Now, year to date, the S&P 500, it's in the green, 0.3%, relatively flat. And once again, the dividend compounders with Cheese portfolio is beating him. And if we zoom back 1 year, give it a little more time, 71% versus that of 36%. The S&P 500. The total return for the dividend compounders with Cheese portfolio is 88.7%. The S&P 500 is 61%. So I've been beating the market consistently every single year since 2019. If you want to hear why this portfolio only goes back 2.5 years, watch episode 1.5. And I wanted to circle back and talk about the trade desk. No, I did not sell out of them. I think at its worst, I was down, I want to say $1,200. Yes, into the red. I didn't paper hand, I didn't panic sell because the investing thesis still holds true, right? And if you take a look at what's happening to them right now, in the past 7 days, the trade desk is up 25% into the green. In the past 24 hours, they're up 20%. And if you take a look at my cost basis, it's $41.75. I kind of wish I would have better calculated my opening position on when to jump in. I think I was a little too quick. If I were just a little bit more patient, I would have been able to pick up shares of the trade desk when they were 25, let alone 21, whatever cents a share. And the amount of capital that I have deployed into the trade desk is $2,700. And as of right now, it's $1,900. So I'm in the red, $777. However, I think the tides are turning for the trade desk, and I think this is where it all changes for the trade desk, and they're going to slowly go back into the green. And the reason being is that the rumor circulating on Twitter and all over the internet is that OpenAI approached the trade desk discussions, conversations, and talks in order to exclusively partner with them to put advertisements on ChatGPT, which is huge. And to add another growth catalyst to the fire, the CEO of the trade desk, he spent $148 million of his own personal money in order to gobble up 6.4 million shares in the past 48 hours. So not only does he have a ridiculous amount of RSUs and stock-based compensation, he said, hold on, the stock price is so low that I'm going to spend $148 million buying the bottom. So that's why the markets are going crazy, and because he put so much money into the stock, I'm sure that it helped bump the stock price as well. So me personally, as I depicted in my initial investing thesis video for the trade desk, it was never a buy and hold for me, and I do have an exit strategy when it comes to the trade desk, and it just goes to show that through my emotions of being upset and disappointed that my position in trade desk was down like $1,200. Had I just sold out of them, I would have missed out on the $500 of gains that just happened in the past, 48 hours? And I think it's going to slowly keep chipping away. And I think my cost basis is eventually going to be into the green. I don't think it's going to happen tomorrow. I don't think it's going to happen next week. I think it's going to be a slow and inevitable climb back into $35 a share, $40 a share. Now, obviously, I could be wrong, but I think it's a pretty good sight to see. I mean, especially with the $148 million being pumped into the stock from the CEO himself. I think that gives a lot of confidence. And I think the same is true with the SoFi CEO. The same is true with ServiceNow CEO. And same with Duolingo's director, right? I think they're all buying up shares of their own company stock because they're realizing, like, dude, they're at a 5 or 10-year low, so I'm going to be gobbling up as much shares as possible. And so if they thought that the company was a burning ship and behind the scenes that we don't have knowledge of, if it was that messy and of a disaster of a situation, would you realistically be putting $1 million, let alone $148 million into that stock, right? So it almost makes you wonder and think. So I still feel pretty bullish about the trade desk, and we'll just see what happens. I'm going to be holding on, and yeah. Now in the next section of the video, I'll be going over with you my game plan, what I would hypothetically do if I won the lottery, which, by the way, I do not buy lottery tickets, or if I inherited a lot of money, such as somebody passed away, a close family member, and I got a lot of money, or an Uber driver ran over my foot and I got a settlement payout, or if I signed a professional athlete contract with the NFL, knowing full well that my playing career on average would only last about 3 years. What would I do with my capital so that I don't just crash and burn my cash pile, so that I can utilize that generational wealth? Because those rookie contracts for the NFL, I mean, sometimes it's like, what, 600 grand? But if you're a first, second, or third round pick and you hit all of your performance incentives in the contract, dude, you could hit easily millions per year, at least for those 3 years that you're playing in the league. How would I use that generational wealth to set up forever passive income? And between you and me, that's a career field that I'm flirting with. I might just mess around one day and just knock out my CFA and CFP certifications and just enter the private wealth management space and partner with the agents of these stars in the NFL, the NHL, the MLS, so that they can use their money to set them up for life. Not just for them, but also the generations to follow after. Which, funny enough, I do have 2 friends that went to my undergrad that went on to law school and became agents for several NFL players. And I know this because I follow them on Instagram, but I almost feel bad for just reaching out being like, hey, is there any way you could, you know what I mean? So maybe I can get my foot in the door doing it my way, but we'll see. I think that would be pretty cool, right? Because if you can't tell by my background, and I'm a huge sports guy, Seattle Seahawks, Seattle Sounders, Wrexham, Tottenham Hotspurs. Obviously with Tottenham, we're going to get relegated down to the championship, which means Wrexham and Tottenham, they're going to be playing in this exact same league next year, which I think is going to be kind of hilarious. However, if I could just blend the two, my love for sports plus helping these stars manage their financials and investments, dude, that would be sick. So if my life were to magically change one day and I were to become lucky and inherit or gain a lot of money, to be honest with you, I'd be putting it all into SCHD and calling it a day. And I'm not joking. I'm not exaggerating. No, Charles Schwab, they're not paying me to say that. And here's the reason. So SCHD is a really unique dividend ETF because not only do they give you a very juicy yield that's around like a 3.3 to a 4%, but the dividend growth rate, the CAGR is usually 10%. You get Parmesan on top of your dividend payouts year over year. And if you take a look at their performance, I mean, it always makes me giggle when people talk about how dividend investing does not work. And if you're under the age of 50, you should not be doing it at all, when the facts are that dividend investing truly works as long as you're investing into the proper high quality dividend payers that do not have destructive return of capital, NAV erosion. So if you take a look at their total return, maximum timeline, it's 489%. So you essentially would have 6x'd your money with SCHD if you were to invest into them in 2011. And if you take a look at them, it's a slow and steady, reliable compounder throughout the ages. And what I mean by that is if you take a look at their average return, their CAGR year over year, 13% is how much your capital, how much your money, how much your portfolio would have grown. 13% year over year. And if you only consider the past 365 days, then your capital would have grown at 16.4%. So talk to me about how dividend growth investing doesn't work. Talk to me about how it underperforms. It really doesn't. I think it's one of the best low stress ways to invest in the stock market. And I think this is where I need to pump the brakes, park the car somewhere with a little bit of shade, and apologize. Because in the past year, I made video after video talking about SCHD and my problem with the fund managers, right? I criticized them for being balls deep into energy, oil and gas, telecom players like Verizon. I was like, what are we doing here? However, they defy the odds. They proved me wrong because in the long run, they were right. Their investments are paying off dividends quite literally, and it's why they continue to crush year over year. If we jump on over to the holdings tab and you take a look at the 100 positions of SCHD, I think the 101st is just some cash or T-bills. Take a look at the sector allocation. It is so balanced. No sector is allowed more than 25% of the weighting. Actually, let me back up a bit. I think the reason why I'm such a big fan of SCHD is that the index that they follow, it makes all the sense in the world, especially their screening metrics and criteria in order to join SCHD and how they prioritize the weighting. So SCHD follows the Dow Jones US Dividend 100 Index, and to qualify to join that index, the 100 stocks, number one, your dividend history, 10 years of you paying dividends, meaning no cuts, no pauses, no ebbs and flows. You need to be consistent, reliable, and predictable. And then number two, your market capitalization needs to at least be $500 million, which I agree with. I don't really like going near small cap companies because of the volatility implied. And then number three, the liquidity, right? The average trading volume needs to be at least $2 million of shares exchanged. And then when you do that to filter and screen the companies in a very strict manner, it gets rid of a lot of the cigar butt companies. And it doesn't stop there. So what happens next is that the fund managers of SCHD, they look at the US Dow Jones 100 Dividend Index, and then they prioritize them based on their free cash flow, their return on equity, their dividend yield, and their dividend growth rate. So when you think about it and look at it, the top 10 of SCHD, it's a value investor's dream. You pull up their financials and fundamentals, they're crushing it. You look at their dividend profile, the yields are usually like 3, 4, 5, 6, 7%. So the top 10, I'm going to be honest with you, last year I was dogging on them. I was like, why are we investing so heavily into oil? And embarrassingly enough, I disagreed with them, but they proved me wrong. It's because the oil and gas players, they're probably one of the best performers, at least in the past 6 months. Chevron, 20% into the green without factoring in their juicy dividend profile. And we can do it again with ConocoPhillips. Past 6 months, I don't know, 22% into the green. By the way, that's only the share price appreciation, how much this number is growing. Once you bake in the dividends, 2.9% dividend yield, it gets better. That CAGR gets better. So individually, the top 10 positions, like Lockheed Martin, I love this one. I'm super bullish about their future trajectory. And if you think about all of the conflicts that are happening around the world, a lot of the missiles, a lot of the weaponry, a lot of the equipment, the jet planes and the drones, they're manufactured and sold by Lockheed Martin, especially their Skunk Works labs, the stealth projects that they're operating with. We don't even know what they're doing, but if I were to make a new military stocks video, which I seem to do every 6 months, Lockheed Martin could easily be number one for me as of right now. Individually, each one of the top 10 stocks, about 4.9%. ConocoPhillips is 4.5%. So around like 4 to 3%, right? And as we scroll on down to take a look at the ones that just barely made it into SCHD, they're just negligible, right? You take a look at Anus. That kind of sounds like my name's Amos, but 0.02%. Oxford Industries, 0.02%. So these ones right here, I would say the bottom, like 25? No, we could even push up that number even more. I think like the bottom 70 to 71 stocks don't really matter. I think it helps diversify the fund itself, but I think the heavy lifting is truly done by the top 10, dare I even say the top 15 because of their weighting within the portfolio, and it's hard to disagree with the top 15. I think the only one out here that kind of stands out to me as kind of like a yellow flag is UPS, but once again, I was wrong, right? I think their turnaround story is actually, it's happening. Take a look at them past 6 months, 23% into the green. UPS is a position that I sold at a loss at the end of last year because I just had zero faith in their executive leadership team. But it seems like the fundamentals of the company, it's disconnected with the performance of their stock price. And I say that because 6 months, 23% into the green, but you take a look at their financials and fundamentals, it's pretty rough across the board, especially year over year, trailing 12 months. Like for your bottom line per share, this is what I'm looking at right here. To go from $14.68 in fiscal year 2021 down to $6.56, I don't know what planet we live on, but to me, I think that's atrocious. To decline by more than 50%, yeah. And of course, if we jump on over to their dividends tab, you take a look at their payout of $6.56, 100% of their profits per share are being utilized to fund the dividends. Now, the cool thing about SCHD is I'm not too concerned. You might be like, well, hold on, isn't EPS going to pause, cut, or freeze their dividends in the future? They very well might. But the cool thing about SCHD is that annually, sometime in March, I think it's going to happen any day now, the entire index gets flipped upside down, left to right, and they start to prune or get rid of the ones with red flags across the board. So I think UPS might be on the chopping block, to be honest with you. And I think another one is ticker symbol LYB. To be honest with you, I forgot what the company is called, but they did just cut their dividend, and I think they are a part of SCHD. Yeah, right there. LyondellBasell Industries. Hop on over to their dividends tab. They cut their dividend. So I think this one is soon to leave and exit SCHD, and I think that's another reason as to why I like SCHD so much, is that they do all of the heavy lifting and the work for you. They bring in the ones that pay a juicy dividend that's good in the next 365 days. However, if something changes in the next quarter or in the next 3 quarters, once they have their reconstitution in March, that company's going to be let go. So it's not going to be weighing down the team too much. And I think at this point, I'm preaching to the choir. The guy in the back, he's falling asleep. The wife is nudging him, like, get up, you're embarrassing us. He's drooling. I think we all get it. SCHD is a really amazing dividend growth ETF. I think it's one of the few dividend-oriented ETFs that makes sense for everyone. Even if your priorities are CAGR and performance or passive income, I think it's like a one-size-fits-all, except if you're really fat. You try to put on a suit, it's kind of like, it doesn't really fit me, I can't get it over me. But changing gears a bit, let's go ahead and assume that we come across, I don't know, like 750 grand, $900,000, and then after taxes are considered, let's just say that we have, I don't know, in a perfect world, okay? Say we're working with $500,000. This is why I would put it all into SCHD, call it a day. Let's see if everything looks okay. The dividend growth rate is actually higher than 8.5%. I believe it's like 10.5%, but we'll just leave it at 10% flat to add a little bit of a margin of safety. We don't want to be too optimistic. We don't want to look at a pile of dog poop and say, oh, that looks like diamonds, right? We want to be a little conservative. The stock price appreciation, I think 5% might be a little too low. But you know what? I love it. Let's play with that. And years to invest. So I'm 35, assuming that this happens right now. I get super lucky and we see, I don't know, 20 years. And I'm not going to put any more money into it. I'm going to be utilizing the dividends in order to sustain life, to pay the bills and everything else. Let's see what happens in the span of 20 years, right? Just allow SCHD to get bigger by itself, because with dividend growth investing, you don't have to sell your shares and reduce your ownership into a business, into an operation, or into an ETF. You can maintain what you have and just collect the passive income. I think that's what blows my mind about the traditional FIRE folks. You might have 10,000 shares of a company, but throughout the span of time, in order to do your 4% withdrawal method, you're going to be reducing that 10,000 into 9,000, into 6,000. And eventually your ownership of that company is going to be like 1,000 shares down to 200 shares. It just blows my mind. Why do that when you can just keep your ownership at 10,000 shares or at 20,000 shares and just collect the profits that are paid out in the form of dividends? I think when it comes to dividend investing, you either get it or you don't. I think the same folks that get dividend investing, they're also associated with real estate. Once you build the land and you do whatever it takes to have buildings operating with tenants paying you rent, that cash flow, you don't want to just sell the buildings. You don't want to just sell the land, right? You want to increase your empire, increase the amount of apartment complexes, townhouses, or whatever that you own, commercial buildings, to keep collecting rent from the tenants. Whereas with this side of the house, with selling your principal amount, selling out of your ownership, it's like, well, you can have this apartment, you can have this townhouse, you can have this commercial building, and eventually they own nothing. And don't even get me started on them having to sell when the entire stock market's in the red 20%, or if we're operating in a bear market for 9 months or 16 months, or if you're trying to tap out and press the fire button, but you can't because we're in an economic downturn and you don't want to sell your $5 million portfolio when it goes down to $3 million. The paper losses is a psychological reality, right? So I just don't understand. Like, I get it. Mathematically and on paper, it makes sense. If your portfolio increases by 10 to 11% year on end, and you're only selling 4% of it, then theoretically the portfolio should outlast you, because what you're taking out is not more than what's appreciating year over year. But on this side of the house, when you just collect a 4, 5, maybe even like a 7% passive income year over year on top of what you own, and you don't have to let go of anything or cut or prune, it just makes more sense to me. But anyways, with $500,000 over 20 years, and I'm pocketing the dividends, that monthly dividend would be about $9,300 in 20 years. And the annual dividend income in 20 years, so when I'm 55, would be 6-figure salary. And the portfolio's valuation, mind you, I'm not putting any more contributions into it. We're not reinvesting. We're not doing drip. Would turn from $500,000 into $1.3 million. And if we take a look at it play out over time, the portfolio's valuation goes from just shy of $500,000 as of today in the first week of March to, in 10 years, what would it be, $800,000, and in 15 years, $1 million. So without me doing anything at all, I would be on paper a millionaire through my equities and stocks portfolio. And the annual dividend payout, I think in year 0, it would be a little rough. $16,700, which is about 3x of what I'm making on YouTube. By the way, I do YouTube 7 days a week. It's my full-time job. I'm a stay-at-home dad, so it is what it is, but the wife's the breadwinner, and I can't thank her enough for allowing me to pursue my dream while she's doing most of the heavy lifting. But the channel and the community itself, it's growing by the quarter, by the year, so hopefully we can get it up to at least $16,000 eventually for the annual income from YouTube. But if you take a look at how it's growing year over year, I think that's pretty respectable, right? Well, let's be honest here. I think $500,000 might be on the lower end for winning the lottery or a settlement payout. And so let's go ahead and bump it up. And this time, maybe we could say it's like $1 million. And let's say that the reality was like, I don't know, 3.2 million, but after taxes and everything else, it boils down to $1 million, keeping the other factors consistent. Let's see what happens now. So after 20 years, the $1 million would turn into 2.6 million, and the annual dividend payout would be $225,000. That's absolutely wild. That's roughly what I was making when I used to work in corporate America. So to go from that down to what I am of about like $4.5 a year, it's humbling, and it's the reality of chasing your dreams, okay? So if we take a look at the portfolio's valuation, I don't think we really care about that, but I just want to show you why I would go all out into SCHD if I were to come across a lot of money, right? Just take a look at that increase year over year. It's just a beautiful thing to see, right? Now, obviously, I don't know, 1 to 2, maybe even like 3 of these years, I think SCHD would experience a drawdown where they go negative like 15, maybe even like negative 20%, and then it'll make up for it in the other years. So what you're seeing is like a blended out average throughout the years. I don't think it would be this smooth and steady. And I say that because if we just take a look at SCHD's price history in its own past, you can see that during the pandemic sell-off, they dropped off a cliff. They recovered and reached new all-time highs. They went on a sell-off during 2023. They recovered. They went on a sell-off in 2025. They recovered. So it's not a smooth and steady where consistently it's going to be going up 9, 10, whatever, 11% year over year. But once you blend it out, that's kind of what it would look like. So what we care about is the annual dividend payout. Year one would be $33,000. And in year 5, we're talking about $53,000. And in year 8, going on to year 9, it would be the median household income here in the U.S., about $71,000 to $79,000. And in year 20, $225,000. I mean, that's really good. Now let's just do it one more time and assume we won the biggest lottery payout in history. And it was like, I don't know, $9 million, $11 million after accounting for taxes. Let's assume that what goes into our pocket is $5 million. And by the way, I think there's always the trivia question going around social media when people do street interviews. Would you rather take $500 every month for the rest of your life or a lump sum? Doesn't matter. Always go for the lump sum and invest it into a vehicle or a position that can grow at a 10, 11, 12% year over year. High S&P 500 ETFs, high SCHD, because that would be a better ROI, and you can use that money to work for you right up front. Because tomorrow's not guaranteed for anyone. You take that $500 low payout today, who is to say you're going to live to see next year? Right? You might as well get it all up front and use that cash to build more cash. Case in point, if we were to put $500,000 into SCHD, eventually it would become $1 million. And you would be getting a dividend income every year that's pretty respectable. So with $5 million all into SCHD, how does that change the name of the game? After 20 years, friends and family, without doing anything, without doing drip, just sitting back and allowing SCHD, a dividend-oriented ETF, to do all of the work, it would be $13 million. And the annual dividend income at the end of the 20 years when I'm 55 years old, when all my hair is gone, it's gray, I'll have a Confucius beer right here, $1.1 million of dividends. Now, obviously, it's taxed at 15%, so I guess we should bump it up to 20%, okay? And if we say the share price appreciation is 4.5% instead of 5%, how does that change things? The portfolio's final valuation would be $12 million. And if we just take a look at the annual dividend payout, year one, $167,000 in dividends. Are you freaking kidding me right now? And as you fast forward, just take a look at this, right? That's exactly what I would do. If I were to get hit by an Uber driver, if my DoorDash driver would have spit in my food and I win a settlement, I'd just put it all into SCHD, call it a day. And I don't know about you, but I would be a pretty happy camper. No, the $5 million's not going to turn into $500 million overnight, like with some of these yield max or crypto or get rich quick schemes that are floating around the internet. But the slow and steady, the battle tested, the tried and true, the consistency, I would take that any day of the week over something that can promise me 20x or lose everything. I would just rather go with what's offering a CAGR of like 10, 11, 12%, or I guess in SCHD's case, 13% year over year. That guaranteed 13%, I say guaranteed because sometimes it's going to go down by 15%, but if you smooth it out and you blend it out over the long run, a 13% CAGR, I'd rather just go with that. Now, changing gears a bit, for the third part of the video, let's talk about why do I do so much research and why do I make content about high-income ETFs? Well, friends and family, that's because I'm in a very hairy and smelly pickle of a situation. I'm in my mid-30s and I'm taking a very calculated risk. I'm betting on myself that this YouTube stuff is going to work out. And according to the numbers and the metrics, seems like it's working slowly but surely. However, at the same time, my mom, I was raised by a single mom. She's in her mid-60s. And it's just one of those weird realities of life where I think this is something that every man goes through, right? Once you look at your parents that you used to once be scared of, or you used to look up to them, or you admire them, whatever it is, inevitably, all of them, once they hit 65, 75, 85, and you start to notice, man, they're getting old. Man, they're getting really frail. They're getting weak. They might have a whole boat of health complications. And between you and me, I'm feeling that stress because she doesn't have a retirement game plan. She doesn't have savings. So I'm stressing out about the fact of how am I supposed to support myself and my growing family while at the same time, how can I help her, especially in her twilight years of reaching 70, 75, 80. And I know the common wisdom on the internet is your parents, they're not your responsibility. It's their fault if they did not save up for their life after retirement. Just turn your backs on them. It's okay. But at the same time, I'm just not that kind of guy, right? Like she sacrificed so much to raise me. Like you guys don't understand how much poverty and how much crap I had to go through growing up in order to just be where I am at today. And I think some of you watching this video, especially if you come from a blue collar background, immigrant family, or if your family is kind of similar to mine where they had zero financial literacy, or if you just grew up with nothing, you quickly understand that our parents, they were just, or our caregivers, guardians, they were just doing the best that they could with the knowledge that they had. And the harsh reality is, when it comes to most of this investing and the stock market stuff, your dad or your grandpa, usually they pass down that knowledge to you and it stays in the family. And that's where the term generational wealth really becomes relevant. Like that $800,000 that your dad inherited from his dad, and eventually he passes that $6 million portfolio down to you, and it just allows the rest of the family lineage to be okay, right? But for most of us, I would argue maybe 40, 55% of the people watching this video, we had to learn the hard way, and we had to be the first ones in the entire family tree to be like, wait, hold on. We can't keep living paycheck to paycheck. We can't keep doing this and giving our future family members nothing. We're going to be the first ones to set in stone the foundation in order to build something that outlasts me, and then it'll carry on over to the next family and then trickle on down to the next family. But what really boggles my mind and gets my panties up in a bunch is like, how in the past 5 to 10,000 years of all my ancestors, how am I the first one to be like, we got to invest our money, grab some land, buy this to have capital work for us in the future? How am I the first one? I don't know if anyone else can feel that frustration, but it's also kind of like, okay, well, I have that burden and it ends now. And so circling back to my mom, dude, she knew nothing about real estate, nothing about bonds, nothing about stocks. All she knew was how to work 2 to 3 jobs at any given time to just put food on the table and make sure that we were not homeless. And it really makes me emotional and sentimental when I understand now with maturity and wisdom, she gave up everything in South Korea in order to immigrate to the US to try to give me, her child, a better life at the expense of her own future, and especially at her life at the time, right? When you go to another country without anything to your name and you can't even speak the language, dude, you're going to start at the bottom of the ladder. And that's why when I reflect on the time that I backpacked around the world, all over Asia, all over Europe, people would meet me and they would immediately know that I was an American. And they said it's because of the positivity and the optimism. Because when you think about it, our entire lineage of Americans, for the most part, they left everything in their homeland to come to the US with hopes, aspirations, and dreams. And you can't really do that unless you have stubborn-like optimism that one day it'll get better. And I think that's a personality trait that manifests in all of the hardworking immigrant families, whether your family came from Italy, Ireland, Bolivia, or in my case, like Korea. And for the most part, we leave behind our old identities and we become Americans and we become value adds and contributors to society. And so at the same time, even though I am feeling stressed about her getting older and what's going to happen next, I don't see it as a burden or even as like an obligation. I just see it as it's my turn to take care of the person who took care of me when I was younger. Like, I'm going to help set her up right and try to come up with a game plan of how we're going to make it work. And that's why I've been doing a lot of research about high income ETFs. Like in one part, like 5% of my brain, I did it so that I can future proof and have a game plan for myself when I get older. But the real reasoning is for my mom, right? And that's why for those of you that are retired and you're utilizing high income ETFs to fund your lifestyle, you know that it actually works as long as you're not putting your money into destructive return of capital investments. Shout out to you, YieldMax. And hopefully that answers the question. If you've ever been curious, why does this young kid keep uploading content about the QQQ income ETFs or the S&P 500 income ETFs? Like, why? That's the real reason why. I'm doing all of the legwork and the research to figure out which ones are actually going to work and will stand the test of time and provide a reliable and a steady 10, 11, 12% dividend yield. Now, if you haven't already, I actually just uploaded this past week the best NASDAQ 100 income ETFs and the S&P 500 income ETFs in a data-driven analysis. Meaning I analyzed and evaluated all of the various players out there, not just by the dividend yield. Some of these other YouTubers, that's all they care about. Oh my gosh, a 15% dividend yield. There are other factors that are far more important, and that's what I prioritized and what metrics I considered. So if you haven't already, I would encourage you to catch up and watch those videos. Now, having said that, I love you guys. I think I said too much. I shared way too much about me and my personal life, so it's kind of a weird thing, but I also trust you guys, and I consider this community my friends. You guys are my friends, so stay safe, good luck in the stock market, and I'll talk to you guys really soon.